Welcome back to Focus Fridays, the series where we open up the playbook on real estate investing, covering everything from core fundamentals to the sophisticated strategies that help investors grow wealth with confidence. I'm Jared Shum, head of investor relations here at Focus Capital.
I'm Chad Sheeler, founder of Focus Capital.
So today we're answering a super practical question. It's a good build up from last week's episode, but how do real estate investors actually get paid? So we talk about like, hey, this is passive wealth, wealth building, long-term vehicle, but like, how do we actually get paid? So because people hear about returns in real estate, they often assume it's just one way for real estate investors to get paid. But in reality, investors get paid in several different ways. And when people talk about a 2x multiple or a 1.5x multiple, that doesn't just come from the sale or a liquidity event. So let's start with the big picture. What are the main ways that investors earn returns in real estate?
I think it's a very, very common question. I think people either in one of two camps. One is they think that all the returns come throughout the year, every year, or they think it all comes in one big lump sum at the very, very end. Mm-hmm. And it's important to note that you get paid really two ways. Most deals, right? You get paid through distributions, usually quarterly or monthly throughout the year, from the cash flow derived from the property after the income, expenses, and debt service. And then once we sell the property at an exit event, then there's a large lump sum there from the capital gain. Third way would be a refinance in the middle there, which would be non-taxable event, but it'd be another way to get paid as an investor.
Yep. And so we do cash flow and distributions. We're gonna talk more about that in just a minute. Appreciation, I think, is another way, because it's like if they're not in a syndication, like you can still be owning a property and that's appreciating. So you're getting paid indirectly on that, because then obviously you don't tie down. Yeah, exactly. And then the loan amortization, having other people pay down your mortgage for you. So as long as you have tenants and you have that cash flow is kind of hitting 2 points. Yep. One, the distributions that you could take if you were, a single operator. And then also the having somebody pay down your loan for you. So you're building equity within the actual physical asset. And then, like you said, the capital events of like refinance or a sale. So real estate is really one of those unique alternative investments, because it can produce income today while also building up equity over time. I think that we should start with cash flow. We do quarterly distributions here. Some people do monthly distributions, but how does that work for investors? Does that mean that 100% of rents go to, we just divide that by how many LPs are in the deal? Where does the cash flow come from, and how are distributions calculated?
Yeah, well, that'd be great. What if all the rents came in, you get all the rents? No, there's expenses, right? Yeah. You have your income coming in, you have other income, you've got expenses like insurance, taxes, repairs, maintenance, contract services, and reserves, right? Mm-hmm. And then after all that is your net income, and then you have your debt service, which is your mortgage payment, right? Depending on your debt service, whether it be interest and principal or just interest payments. Beyond that is your net income of the property. And we look at the net income from the property over each quarter, and we determine, okay, out of that total amount, what percentage will we give to our investors? And it may not be all of it. It may be 90%, maybe all of it sometimes. We always want to hold back reserves to the property and foresee ahead what's coming up, to where if we know we may have a lot of vacancies coming up or a lot of turn costs or capital expenditure, we'll hold some back for the property to keep those reserves in place. But typically, majority of that cash flow from the net income gets split pro rata for all the investors.
And we talked about this a little bit in earlier episodes about cash reserves and what that looks like, and why sometimes that means you're keeping 100% of the net operating income. Yeah. I think that it makes sense to a lot of LPs that it's like, okay, it's not just, they know gross and net. So it's like, okay, it's not just we're going to take this number that the property made and just distribute 100% of that. We get that there's expenses, marketing expenses, maybe operational expenses, all these other things. But explain a little bit on how you guys calculate, how you and the other Chad calculate exactly how much you're holding in reserves and why. Because that part can get a little tricky with investors. I'm like, well, why aren't you giving me my share? Let's say that round numbers, I own 2%. So 2% of whatever the NOI is. Why am I not getting 2% of that? Why am I only getting 2% of 90% or 2% of 85%?
Yeah, that's a great question. First and foremost, the main role we have as an investment manager, we're here to manage the investments. And the last thing we ever want to do is give all the money to investors, then be like, oh, wait, we have a capital call, or we have to do, right? So we want to make sure we're very prudent with our investment management duties here. Mm-hmm. So We went through a calculation every quarter end to look at how much cash was received on a net income basis per property. And we look at what's also in the bank accounts. What's current cash on hand in the bank for reserves we already have in place. And typically we'll reserve between $250 to $300 per unit per year each year for replacement for reserves for CapEx projects. Because there are always capital needs, roofs, windows, big CapEx, HVACs, that kind of thing. So we'll look at that and then we'll determine, do we have enough reserves right now on hand? And then what's coming up the next quarter? Is it going to be a slower season? We have a lot of leases expiring this month, the next 3 months, to where there could be a big potential for more turnover, more vacancy, and a lower cash flow this next 3 months. So every quarter is different. And we want to make sure we do the right job to hold back what's needed. But typically we are able to distribute most of the cash flow.
And at the end of the life of the asset, so let's say that you have one of these liquidity events, insert liquidity event, what happens to those cash reserves if there is still reserves left?
Yeah, well, that's equity. That's an asset for the business, the investment. So you go sell a property, the gain from the sale, plus all the cash in the bank, that all goes to all investors. That's part of our gain.
Yeah, and I think that that's an important thing for investors to realize, is that this cash is not just going to be put in another pocket that they're never going to see again. There's a very real scenario in where you have the exact calculation or a very close calculation of what you need for HVAC, for roofs, for all these other things. And so that capital does get used towards the asset, but you're also building equity in the asset, so it's still going back into it. But that cash pile may or may not exist at the end of the hold period of time. But if it does get redistributed. So it's almost like taxes, where it's a later thing and that.
Yeah, it'd be nice to have it paid out earlier, right? For the time value of money, opportunity cost of capital. But again, kind of goes back to us being a prudent investment manager. I mean, it'd be nice to pay it out early if we could, but yeah. And also on the quarterly reports, we show the financials and it shows the balances right there on the balance sheet.
Yep. So let's move on to another way that investors can get paid is through appreciation. How does that typically show up? I think that a lot of people only think of the property value increasing. And so that's not a direct cash payment. But as long as you are part owner in an asset, and appreciation is a way that you know that you're building up some type of, more equity, which will again result in some type of cash flow at the end or a cash event. I think it's often realized most of the time, either at sale or a refinance. And so if you're building up appreciation and you have a refi, you could get, all of your capital return during that refinance, depending on how much that asset has appreciated. And then one thing that I think that a lot of people don't consider is that just holding an asset doesn't make it appreciate. That's driven by market growth or improved property performance. So let's say that the market is steady. How do you as an operator make sure that you kind of contribute towards that appreciation from an operational perspective?
Yeah, great questions. And nowadays, the only way you get appreciation is by forcing it. You have to actually perform the property better to get the appreciate. Years past, it was easy to maintain a property at the same level, and you had rent growth in your favor, and you had cap rate compression in your favor, and interest rates going down, and people would pay more for the property because it was just worth more on a cap rate basis. They could borrow more money. But nowadays, it's not the case at all. So for us, we're always increasing the value, whether it be through rent growth or expense reduction, and just making improvements to the property to where we can actually grow that net operating income. A good example would be last year, we had a property, we increased almost 20% in value.
What is the average property appreciation over, let's say, a 5-year period of time?
It's a great question. I would say at least 30 to 40% would be the goal.
Okay.
That's a good one there. We'll look that one up.
Yeah. Well, I just think that 20% seems like a lot, but if it's is it 20% over a year? Is it 20% over a 10-year hold? And then is that
for the prior year?
Yeah. So that is an important, secondary information to realize. And so if someone's like, oh yeah, we grew 20%, but we held this for 7 to 10 years versus also 2 to 3 years, it's not a time value of your money, like you said. Moving on to the third out of our 4 points on how investors can get paid is loan amortization doesn't get talked about a lot. And I think that there's a lack of education out there, because when you're an LP, you don't really have to deal with any of the financing. You're putting in your private capital into a fund or into a specific property. And if you know that generally, hey, this is going to be a partial loan, partial, private equity deal, that's as far as people usually understand. But why is understanding loan amortization important, both from an operational perspective, but then also from an LP perspective? Because you're an LP in some of our deals as well.
Yeah. Oh yeah. Everyone, I'm actually. Yeah, the amortization piece, it's important because it's really your equity is growing. Let's say you have a property that has a loan balance of $10 million. Now, let's say the first year is interest-only payments, and beyond that point, you're paying principal and interest payments, right? Let's say you pay down the loan by $50,000 in principal every year going forward. So you're really adding $50,000 to your equity on that project. At the same time, hopefully you're increasing the value in the project. So you can see over time, you're decreasing your debt service, your loan balance, and you're widening your gap between the loan balance and the value of the property with your equity.
Yeah, and I think that they're like, almost the word paid is almost kind of like, a misnomer, because everyone thinks that that's a transaction, like a current transaction. And while distributions is a way of you getting paid, loan amortization is still a way for you to get paid, because you're going to realize that at a later event. So especially if you're a single operator, like you can see that really clearly, because it's like, hey, if my tenants are paying my mortgage, I'm not having to pay that mortgage. So whatever maybe W-2 income I'm getting, I'm able to keep more of that. Like that's a little bit easier for someone to kind of, tangibly realize. But when you're an LP, these are all paper gains. So on paper, you're built this is silent wealth that's accruing, but you're not getting paid out on it monthly, quarterly, or even annually.
Yep.
But that's all adding towards this end liquidity event.
I think what's really valuable there too is the refinance event, because as you're paying the loan down and you're increasing the value, now your refinance event to pull cash back out, that trapped equity in your property, that's even greater, right? So I think some people also just kind of forget that. They may not understand that real estate is actually a great investment, because the loan is being paid by your tenants as well as the expenses from the income it derives. So if you buy the right property at the right price, you should have completely free cash flow on your investment you put in there.
Yeah. And then when we talk about refinances or sales, these are capital events. So what happens there? So a refinance, the hope is that you return the capital while still holding the asset. And so what would that look like? We have even talked about a refinance of one of our properties here. What does that look like from a hold time perspective, from a return on capital perspective? And how does that affect our LPs on ownership and everything like that, especially when their capital is returned?
Yeah, great question. So typically when a refinance event takes place, first thing is to pay back their preferred return that's been accruing, right? And beyond that point would be a return of capital to reduce their capital balance.
And then after that, like you're still holding it. You haven't sold the property.
Still hold the property. It's a non-taxable event, so that if they get a check for $80,000 on a $100K investment, it's not taxed at all. Whereas getting new debt in the property essentially.
Gotcha. And then a sale, realized profit, capital distribution. When you've done sales in the past, how quickly does that close look like? And then when do you distribute? And then how does that distribution happen? Is it, the same as your monthly distributions? It comes the same way?
Same as the portal. It goes to the portal, and we would close in the asset. I'd say within about a month and a half, at the very latest, we'd have complete financials. It'd be closed off with a financial wrap up there, and we'd be dispersing funds to our investors.
In summation, I think the biggest takeaways from this episode, because we could obviously do an episode on each of these points, cash flow, loan amort, et cetera, is investors get paid in more than one way. It doesn't have to be either or. It can be, but traditionally it's not. And returns often come from multiple sources working together over time. We talked about how, appreciation and loan amortization kind of work hand in hand towards a refinance, towards a sale. And so all three of those things kind of have to go hand in hand to be able to kind of have that happen and increase your guys' equity at the end to make sure that the equity multiple is higher. And so it's not just a sale or refinance or cash flow distributions. There's a lot of other pieces in there. And so understanding where returns come kind of helps our investors evaluate opportunities more clearly and not just headline numbers. There's a lot of people that are only focus on IRR, but don't really realize all the ways that they're silently building wealth.
Yeah.
Is there anything else that you would want to add on, how investors get paid and how they should evaluate deals if that is their biggest focus?
No, I think it's important to know, to understand the different ways they get paid, right? Because some people just may think this is one sum at the end, or there's a big amount per year every month, or maybe a guaranteed amount. It's just important to know kind of how it's structured and know where those two different buckets fall into place.
Yeah.
And to know really that a refi is actually a great situation for a non-taxable event.
Perfect. Well, excited for our next episode.
Let's go.
Thanks for listening to this week's episode of Focus Fridays. We release a new episode every week, so be sure to join us next Friday and beyond. If you'd like to see our next investment opportunity before it goes public, you can join our investor list by filling out the form on our website, focusedcapital.com. If you have any inquiries about what we've covered on our podcast, general real estate investing questions, or suggestions for the show, we'd love to hear from you. Feel free to reach out to us anytime by emailing us at investors@focusedcapital.com. Take care, and we'll see you next week.